This is Barry Knapp from Ironsides Macroeconomics. It's Monday morning, March 25th, 7:20 Mountain Time. This is the free version of the summary, our weekly summary of our weekly note that goes out to paid subscribers. This week's note was titled Itching to Ease. It was very much a deep dive into last week's Fed meeting and the outlook for policy going forward. To begin with, it was very clear based on the changes to the summary of economic projections, that is, participants' expectations of stronger growth, a little faster inflation, though the faster inflation was really just an acknowledgement that it picked up in the first 2 months of the year, but they don't really expect the run rate to have accelerated much. We might disagree with them on that, but nonetheless, they're willing to look through those couple of months because they kept their median dot for 3 rate cuts intact next year. Now, that was barely so, but nonetheless, that's still where the committee is at right now. And it was very clear from the press conference that there is a bias to ease. As Chairman Powell talked about the potential reaction to stronger employment, he said that would not be a reason to tighten or would not preclude the 3 rate cuts that they expect. But were the labor market to weaken, which is our quadrilemma thesis, right? The idea that in order to get the Fed to cut to 4, keep the 10-year note yield in the vicinity of 4, we'd need an unemployment rate above 4 and wage growth below 4. It's pretty clear that were that scenario to unfold, the Fed would start cutting aggressively. So that we've talked a little bit in the note about twin policy puts, and that's the policy put against growth weakening. They would start cutting rates aggressively. This brings us to discussion of the balance sheet, which they made clear because of declining balances in their RRP program and concerns at that point that reserves would start falling dollar for dollar alongside QT, and their concern that they'd get tightness in repo rate markets, liquidity for banks, that they are going to taper QT. Now, tapering QT to us is not as bullish as the market initially interpreted it to be, because Powell also mentioned they are going to discuss the maturity profile of the system open market account or their balance sheet. But again, though, there's something of a put around that as well, because if the data did not cooperate and 10-year notes started making another run at 5%, something like what occurred last fall, it's pretty clear that they would push out any change to the maturity profile of their system open market account, which only contains 3% bills, even though issuance from the Treasury is over 20% in bills right now. But they could push that out and just slow QT and try and calm the bond market down that way, similar to what happened when the Treasury shifted issuance around last fall and the Fed paused their rate hiking process. So those are the twin puts that are hanging out there. We then dug in a little bit around this financial instability rate and the fact that the banking system really does need the policy rate to get down to 4% or so in order to ease the pressure on their securities portfolios and make them willing buyers of all the issuance that we're going to get in the second quarter, some $500 billion increase in the amount of coupons outstanding. This week, we're getting 2s today, 5s tomorrow, and 7s on Wednesday. This is the stuff that the banking system needs to participate in. The size of these auctions are going up. And for the banking system to buy those, they really do need to believe that that policy rate is going to get down to 4% or so for the curve to disinvert to make those securities carry positively. Otherwise, banks shouldn't be buying 2-year notes or 5-year notes. So the third issue we really went through was the Fed's third mandate, which we think was unspoken throughout the press conference, which is low and stable interest rates. And in order to get that, the Fed does ultimately need to be cutting rates and disinverting the curve, again, to make banking system willing buyers. And so we dug into that on the note as well. Ended with a little bit of discussion about inflation and growth. We're not really going to get a lot of data around the labor market until next week. That'll be really crucial. We do think underlying demand for labor has weakened a lot for small businesses. We've seen things like the NFIB surveys, labor market intentions have weakened a lot, and their overall confidence has weakened a lot because small businesses are financed at floating rates through the banking system, and small banks in particular. So this is an ongoing issue. We'll have to wait till the following week to get more data on it. And then we discussed vol markets at length. And we came out that the two markets that look really cheap to us are the MOVE index, fixed income vol, and FX vol. If we were looking for hedges right now, that's where we would be going. So that's it for me this week. Barry Knapp from Ironsides Macro. Have a good week, everyone. And if you celebrate it, happy Easter.